Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you for joining me tonight on my latest episode of the Discover Trading series for Wise Bank. Tonight's episode is called Discover How to Trade Breakouts, written by myself, of course, which is James Alexander, and I'm the Chief Market Analyst here at Wise Bank. Now, a little bit about myself. Now, this sort of like, I don't know, sultry, wrinkly, I guess, old-looking man is myself. Like I said, my name is James Alexander, and I'm the Chief Market Analyst here at Wise Bank. I have over 20 years experience in the financial service industry. I actually started out at the age of 18, where I started off in mortgages in the UK. As you can tell, I'm a Brit, so don't hold that against me. So I started off in mortgages when I was 18, specializing in commercial mortgages, buy-to-let mortgages, etc. I then moved into pensions, and then I recognized that there was a huge pension crisis happening around the world. A huge pension crisis. And because here's the thing, the pension system is really badly, it's messed up, which means individuals will have to start learning how to get additional income and wealth from other means, so that when they are ready to retire, they have that income. And this is what got me into the trading industry. And I got into the proc trading. I became a trader myself about 14 years ago now. Okay. So I have actually traded. And I traded for several proc companies. My first thing I used to trade was actually gold options. And I traded through Dubai Gold and Commodity Exchange. As well as that, I ran a trading floor in the Philippines, and I moved into portfolio management. But like I say, my main source of motivation to get into this was because I realized there was a problem in the pension industry. So there had to be alternative ways for people to try and generate income for the future, so that when they are ready to retire, they have something there. Now, I am indeed a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, and things like this. I'm a very avid market commentator. I'm extremely passionate about the marketplace. I talk a lot about the market and what I see and how I recognize things. And I'm a well-known public speaker, and I've spoken at several key events around the world, including the likes of Hong Kong, Dubai, Kuwait, Jordan, recently South Africa, Berlin, and obviously the UK, London, and Manchester, because that's where I'm from. Now, tonight's webinar, okay, like I say, is about breakouts. We'll discover how to trade breakouts. Now, what we'll discuss is what are breakouts. Then we'll discuss the different types of breakouts. Then we'll talk about how we can use these breakouts to spot possible trading opportunities. Then I'll discuss the future educational events for the rest of January and February. Then we'll end up with my usual question and answer session at the end. So if you have any questions, if you can, hold off to the end and we'll discuss it and answer all your questions at the end. So what are breakouts? Breakouts is when an asset breaks through a key level when it's either been ranging or consolidating. The reason why this is key, because traders look for breakouts so they can enter the market and then ride the volatility. So they're looking for a trading opportunity for when this happens. Now, we all know like a ranging market is like this. It goes up, down, up, down, up, down, up, down, up, down, up. And we then can see key levels. If I get my little flashy pen, we can then see key levels or where the market is selling from and where the market is buying from. What we're looking out for, or if you're looking to trade breakouts, is when the market suddenly does this, breaks through the level and goes on a run. This is where we're looking to try and get in. If we want to look and trade breakouts, we're looking for this break, because then we know we can then ride or potentially ride the volatility. Now, there's two different types of breakouts. One is called the continuation breakout, and the other is called the reversal breakout. Now, continuation breakout is like this. This is when an asset is heading in a set direction. So, for example, it's on a set trend. Then the market takes a break, has a little breather, has a little rest, before the trend then continues. So it looks a little bit like this. So this is a continuation breakout. This is the British pound, US dollar on the 1 hour. So this is the cable. And of course, there's been a lot of attention about the cable at the moment, especially with the brick exit and everything like that. There's a lot of volatility. So again, this is an interesting currency pair to watch. On a 1 hour chart. So let's have a little look. Okay. So we can see here the British pound went on a dramatic uptrend. Then what did it do? It took a little bit of a breather. It took a rest. The market caught its breath. And that is when we can then see, and this is what we're looking at, it traded, arranged between these two levels as it was having a breather, and then it continued on its uptrend. So if the break here is when we were looking to jump in to follow the ride higher. So that's the continuation breakout. Here's another example. This is, again, is the euro dollar, again, this time on a daily. What do we see here? Beautiful downtrend. Euro under a lot of pressure against the dollar. So very much on a downtrend. But then what did the market do? It had a bit of a break. It range traded between two levels. And then eventually broke through this level. So when we see it, that's when those who trade breakouts then jump in. Here's another example. This is the euro sterling on a 30-minute. And on a personal note, I trade this pair a lot. It's not the most exciting, to be honest. But I love this pair a lot because you can really sort of, it's a little bit calmer and you can recognize, obviously, breakouts, and when it's ranging, it ranges a lot. And it's a little bit calmer, and you can actually really take a lot of opportunities with the euro sterling. And I like the euro sterling. It's one of my favorite currency pairs. And like I say, I do trade it a lot myself. So this is the euro sterling on a 30 minutes. Okay. And it's a few examples I'm using on the 30-minute because, this is why I like the euro sterling. So again, on a downtrend, then it ranged between the two levels. Then it carried on the trend and broke out and carried on further down before then catching its breath again, ranging again between two levels before then breaking out again. There's another type of breakout as well, and this is called the reversal breakout. What the reversal breakout does is the opposite to continuation, surprisingly. Reversal breakouts start when, again, the asset has gone the same way as a continuation breakout. So you see an upward trend or a downward trend, whatever, etc. It then pauses. It catches its breath, it takes a breather, has a little rest. But instead of continuing on with the trend, what it then does, instead, it reverses the direction. And this is what it looks like. This is the US dollar, Japanese yen on a daily. So here we are looking uptrend. Dollar's gaining strength against the Japanese yen, uptrend. Then what does it do? It takes a breather. The market has a little bit of a break. So straight away, we know it's having a breather. It's trading between two key levels. We know the breakout could potentially happen here if we have the continuation, or the breakout can break below that level of support and we have a reversal like we have here in the example, and the market reverse. And this is when those who trade the breakouts on the reversal jump in. Another example, this is euro dollar again on a daily. Market on an uptrend, euro gaining strength against the dollar. Market then takes a breather and trades between two key levels. And again, unlike the continuation, instead of following up the uptrend, what it then does, it breaks through the support and reverses the trend and goes on downtrend. So again, this is when those trading breakouts will look for the opportunity to jump in and ride the volatility. One more example of reversal. Okay. And this is gold on a 1 hour. Uptrend. Gold is gaining strength against the USD. The market takes a breather, range trades between these two levels. So straight away, we can see what the two key levels of the breakout is. We can see where the key resistance is. We see where the key support is, when the market is jumped in and start to buy in again. So straight away, we know what two levels to watch out for. And like the previous slide, indeed, gold goes on reversal breakout, breaks the support, and goes on a downtrend. And this is what we're looking out for, to jump in and take advantage of the volatility. And here's the thing. When you can start to recognize, and again, you don't use technical indicators for this. You tend to use your own naked eye, okay, to set around your own, like trend lines or channel lines. But once you get to see this, okay, you're not just looking for a continuation breakout. You're not just looking for a reversal breakout. You're looking for both for trading opportunities. So say, for example, this is my example of the euro dollar on a daily again, the bigger picture. It's on its move upwards. It takes its breather. So I know then if I'm watching this, it could be a reversal. It'll go down here, or I'm working for the continuation up here. And it does indeed continue. It then has a breather. Again, I'm waiting for a clear break from here or a clear break for that. For either a continuation or a reversal, it doesn't. It breathes for a little while. It takes its breath and then goes up again on a continuation. And then it has a breather again. This time, I can recognize the two levels where it's trading through. So I'm waiting for either a break higher or a break lower. Indeed, this time it's a reversal. It breaks lower, goes on a downtrend, then has a breather again, breaks a little while here, then challenges it. After going on a downtrend, it reverses and challenges it again, then has a small little breather before going on a downtrend and reversing the trend. So once you can recognize these patterns, these breakouts, you're looking for both a reversal and the continuation pattern to try and potentially make that trade on the volatility. Now, there is methods. Excuse me. Sorry, let me a little sip of my drink. Now, there are methods, obviously, of how to trade the breakouts. It depends realistically on your attitude to risk and your style of trading. And the question I often get asked, how do I know when a level is actually broken or not? Some say, or some people take the stance that when they see a candle open and close below that level, that's broken. I try and keep an eye out for when that level has changed its role, i.e. the support becomes the resistance and the resistance becomes the support. And I'll explain a little bit more. And this is why there's some methods of trading this. Some are more aggressive. They're more foolhardy. And as soon as they see a level broken or a breakout, they'll jump in straight away, setting a very tight stop loss just above that level. It's the aggressive approach. Others, which is the one I tend to favor, to be fair, I tend to see if the support or resistance have changed its roles, are more of the cautious approach. And what the cautious approach does this is when they see the level broken or a breakout, they don't jump in straight away. No, they wait. They wait to see if that asset will come back up, touch the previous support or a previous resistance, and if it bounces off that level and starts to head down, then they know that those levels or the support and resistance have changed roles. So the support has become the resistance has become the support, and that is when they jump into the market. Future educational events coming up for the remainder of the month on the 31st of January, which is a really good one, actually. I really like this one because I talk about hedging, and I do like hedging. The euro sterling and the British pound Japanese yen are the two pairs I use to hedge each other. But on the 31st of January, I will be talking, or the latest episode will be called Discover Correlations and Hedging. That's on the 31st of January. Then, of course, the February schedule will be announced very, very soon. If you wish to contact me directly, you can do indeed by sending me to my email address, which is james.t@wisebank.com. Alternatively, if you wish, you can follow me on my Twitter account. It's a brand new Twitter account. Just really set it up, really. So you can direct message me, whatever you like, which is @JamesAlexanderT. And on that account, I sometimes share levels I'm watching, areas of interest, and market updates. So feel free to come along and tag along if you wish. With all that out of the way, is there any questions? Anybody like to ask me any questions about tonight's episode on what I discussed about breakouts? Any questions at all? Okay. Did everybody at least enjoy it? Or is everybody bored of me already? You hate my voice. You find it boring. No? How can the breakout action described fail? Lars, that's very good. Good question. Now, how the breakout action described can fail is if you get what's known as a fake out. It's not actually a proper breakout. It's where it's tempted and it breaks above it for a little bit, and it's not a proper breakout. This is why, for example, there's no set rule for when making sure the breakout happens. Now, if we go back, like I say, to my slide here, the way of trading it, the cautious approach is an easier way to see if it's a proper breakout or a fake breakout. Because like I say, if you see a level changes its roles, like the support becomes a resistance, then then that's more likely a proper breakout. Now, here's the thing, like with all trading, nothing works 100% of the time. Because otherwise, if that was the case, we'd be multi-millionaires. All of us would be. Because it'd be that easy. But it's not. So the idea is, as long as we can recognize these patterns and take the majority of the advantages of these patterns, then indeed, with proper risk management, then we can long run succeed. Because not every single trade is going to be profitable. Quite a few of your trades would be losing trades. So you need to, understand that. But yeah, it's a good question. Really, you need to look out for fake outs, because fake outs can happen where you think the level is broken, but it's not, and it retraces back. By taking this approach, the cautious approach, it really sort of gives you more of the security to know that that level is broken. Jeff, great. Thanks, James. Oh, brilliant. Thank you, Jeff. Sergio, yes, great. Thank you. David Brown, yes, very interesting. Sergio, again, great explanation. Excellent. Thank you, guys. Thank you for the positive feedback. I like that. Thank you. Is there any other questions to anything else anybody else like to ask me? But that's a very good question, Lars, by the way. Thank you. Any other questions at all? Good stuff. Thank you, Lars. Thank you very much. Chantel, great. Okay, thank you. It's very kind. Thank you. I have a question for you guys, actually. Now, obviously, I write the Discover series for everybody, okay? Thanks, very good stuff. Thank you, Lars. I write this education material, the Discover series, which I've been writing now for, since August. Like I say, I do one a week. And remember, I do it for you fine people, for you guys to learn. I'm not going to give you the golden answer. I don't believe in it. I believe you need to find your own path, your own way to be a trader. So I'm not going to give you the secret answer or the holy grail or anything like that. But what I will say is this, okay, is that I write this stuff for you to help you. So if there's anytime any topics or subject matters you want me to write or you want me to cover, please let me know. And I'm more than happy. Go and write an episode just for that topic. If it's, for example, you want me to do a case study on gold, or you want me to do a case study on the British pound, or maybe you want me to cover a thing which is happening now, like the brick exit or things like that, please let me know. And I'm more than happy. Go away, write an episode for you and present it for you, covering that subject matter. Just let me know, because at the end of the day, this is for your benefit. I do it to try and help you the best way I can. I really do. So if there's any subjects, if you can't think of anything now, you have my email address, you have my Twitter. So like I say, go back. Go back to my, forward actually. My mistake. Hang on. Here we go. Look, here's my email address. You have my email address. You have my Twitter. So if you have any questions, anything like that, email me, or any topics you'd like me to do, write to me. Any direct questions, write to me a question. If I have the answer, I'll certainly answer it. Or DM me on Twitter. Whatever you like, because at the end of the day, I do this for you fine people. Because like I say, I see a massive pension crisis happening. And, unfortunately, so many of us, we're not allowed to play with the big boys. So we have to fend for ourselves. And this is one way. If we get it right, we do it right, it's the one way we can possibly do it. Now, if there's no further questions, I'll sign off. Is there any more questions? Anything anybody else would like to ask me? Okay. If there isn't, can I say which are the three best indicators you would recommend us to use? This is a great question by Lars again. James, which are your favorite best indicators you recommend us to use? Now, okay, and I have done several episodes on different indicators. I've covered a lot about moving averages. Personally, I use the moving average crossover. That's when you take a moving average to say something like 10 and a moving average to say something like 50. And if the 10 crosses below the 50, then it indicates potentially that a trend is changing, that the market is going on a negative. If the 10 crosses above the 50, then it potentially indicates that the market's going on the uptrend. I like that. Occasionally I use Bollinger Bands as well, Fibonacci as well, when I'm looking for a position trade. Now, my answer to this, to you, Lars, is this. There is no set 3 indicators which will work for everybody. Okay? The only way you can see what works best is if you use it yourself, test it yourself, and find what fits your trading style. Now, I tend to use my naked eye a lot. I use trend lines and channel lines, to be honest. That's my favorite. And I don't use indicators for that. I draw it myself. So what I can see where the buyers and sellers are. That's what I prefer, and that's what works for me. Might not work for you, but it works for me. At the same time is that, I use my naked eye more than anything else, and I use fundamentals and market sentiment a lot more. But there's no best top 3 indicators I would say would definitely work. My suggestion is a better word. My suggestion is maybe look back on a few of my other episodes, and if you like, I'll do a specialized episode on moving averages or Bollinger's so you can see which one works for you. What are my thoughts on Bitcoins? In what way, Heather? It's a great question, Heather. In what way? As in, do I like them or do I trade them? Do I think they're great? Bitcoin and I have, me and cryptos have a funny relationship, and I'll tell you why that is when last year, when it was going, no, not last year, 2017, when it was going absolutely nuts. It was like, proper tulip mania. The market was going crazy for it. It was exploding. And because of my stance as an analyst, everybody was asking me, what do I think about Bitcoin? I wrote so many articles about this thing. And I did so much coverage on it that it became such a fuss. I knew it was a bubble. I knew it was a waste. I knew it was going to collapse. I actually called it. I said it would start to collapse at 20,000. The reason why I said that is because at that time it was madness, and people who know Elliott waves and buying behavior in the market, which I do, which is why I knew. I knew that people were buying into that point, not understanding what it is. And I knew that it get to about that level, and then people will start trying to take their money out, and they find out they're not able to take their money out because you don't convert it into cash. It's not really, when you buy it physically, when you trade CFDs, yes, you trade the volatility. So when you trade cryptos with us, you're trading the volatility. You're not actually buying it, which, if you want to enjoy the volatility of it, is the best way of doing it. If you want to buy it as an asset, you understand that you're not buying an asset. You're converting your money into that asset, and then if that asset goes up, then you buy stuff with that asset. You don't convert your money back to dollars, pounds sterling, and euros. That's what it is. Okay. So yeah, no, I'm not look, the volatility was fun. And when we talked about it, I talked about it a lot. I'm sick of talking about it now. But if you understand the volatility of it, then yes. Has the bubble burst? Again, another great question. Personally, again, I cannot give you advice, Heather. Bitcoins, I'd be very cautious of trading. Is extremely volatile. Personally, again, it's only a personal opinion. It's not to be taken advice. I know currencies because currencies, you have the fundamentals, you have the understanding of it, and you have the technicals because you can actually see people buying and selling. So I would prefer Forex over Bitcoins, over cryptos, to be honest. Cryptos, the fundamentals you have is when they do hard forks, when there's new cryptos coming on, and the volatilities, again, can be beneficial, but can also be very deadly. So I prefer currencies because that's just the way I am. Again, it might work for you, but currencies, in my personal opinion, but it's my opinion only, not advice. You're welcome, Heather. Is there any other questions at all? Anything else anybody would like to ask me at all? It's a great question, Heather. Thank you. Great question. Anybody else like to ask me anything else? Okay, okie dokie. If there's no other questions, can I just say a big thank you for everybody? But here we go. A big shout out to Lars, Jeff, Sergio, David Brown, Sergio again, Lars, Chantel, Heather, for all your questions, all your interaction. I love it. I absolutely love it when you ask me questions, you interact, because otherwise it's a little bit lonely talking on my own. So I do like it. I do love it. So thank you. Big shout out to all those people. But at the same time, big shout out to the rest of you. Thank you so much for attending tonight. I hope you found it useful. I hope you found it insightful. Again, like I say, if you have any questions or have any topics you want me to cover, email me at james.t@wisebank.com. or indeed follow me at Twitter and direct message me at JamesAlexander.t or Alexander T, not dot, sorry. On that note, can I just say either a good morning, a good afternoon, or a good evening, depending on where you are around the world. Please don't forget to rate this webinar. If you want to rate it, rate how many stars you like. By all means, rate it to let me know if I'm doing a good job or not. But anyway, till next time, everybody have a fantastic day. Until I see you next week, every single one of you, trade safe.